Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report, the final weekend edition of 2023. This weekend we had a number of calls move around on us, so in the first couple segments here we are replaying a couple interviews from earlier on in the week. More interviews that look big picture, comparing the end of this year to prior years, and a bit more of a focus in the resource sector. In the final two segments of this first hour, we chat with Joe Mazumdar, diving a bit more into this whole concept of miners providing leverage to the underlying precious metals price. We're starting off with commentary from Jordan Roy-Byrne. This was posted on Wednesday. We hope you all enjoy. Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Now Jordan, we're going to stick to some of the charts when it comes to the gold stocks because look, you go back Q4 when it started, the stocks largely bottomed, the metal largely bottomed, and we have seen a nice, almost in a way, stair-stepping pattern higher. I do want to start, though, by comparing this time of the year to last year at this time where gold got completely washed out last year going into the fourth quarter, and the gold stocks were following gold lower. And then we saw a very nice rebound in Q4 the whole way through the first month of 2023, and then bit of a drop for about a month, and then the banking crisis, and boom, everything went higher again. One thing that I want to outline here is that gold, when we go back to pretty much the start of Q4 last year and this year, it's up about 15% heading into the end of the year. The GDX, it's up similar amounts too. GDX was up about 41% at this time last year from that washed out low. GDX up about 29 to 30% this year up until this time frame. Jordan, can you break down some of the similarities and some of the differences that you think we are seeing within this move, especially when it comes to the gold stocks through Q4 to end this year, please?
Yeah, Corey, I think the one main difference is you had a washout. So it was a really good oversold bounce that began at the end of last year or last September, October. I mean, looking at breadth indicators, for example, you had a clear washout. So there's that. And, this time around is different because the miners have they're moving up from a much stronger base of support. The third thing is, I know we'll get into breadth, but we did get a bit of a breadth buy signal, I want to say towards the end of last November. And we did have additional gains from that point. I know we'll talk more about that, but those are really the main differences. And of course, looking at the gold price now, where the gold is in position for a really significant breakout above 2,100, which everyone knows about, obviously, whereas a year ago was an oversold bounce. So you have those things, and then right now the miners are emerging from a much stronger base. Like if you look at the price action over the last 12, 13, 14 months in GDX, GDXj, it looks like they're emerging from a higher low 2 or 3 weeks ago. And aside from that higher low, if you go just below that, there's just an incredibly strong base of support. So you go back to, I want to say like early November, the miners are emerging from a very, very strong base of support. They moved up to some resistance 4 weeks ago or so, and then they had this pullback, call it December, 10th or 11th. And so I think that low is really going to wind up being really, really significant. Like if we look back in a month or two from now, we're going to say, okay, that December 11th point, like that really would have been the best buying opportunity if this all plays out bullishly. So I think those are some of the differences between where we are now versus last year.
Yeah, Jordan. Last year, people were worried that gold was going to fall out of bed, and they weren't really convinced in that snapback rally. It ended up being a bear trap, but at the time it was happening, people were still a little unsure. Now we're kind of at the converse side of this, where we're near a breakout in gold, and people are still not sure if that's going to happen, but at least it's on the bullish side. But you did provide a chart that we'll link below this interview on GDX and GDXj, showing some lateral price support. And to your point, it looks like off of that key support, both GDX and GDXj have bounced. What do you think it's going to take to really break it out into a sustainable trend? What will you be looking for on the GDX and GDXj charts?
Well, I mean, there's a couple answers to that. Gold moving above 2100, because that's obviously going to be a significant breakout. Even in the scenario where the stock market is still moving up, which is possible, which will limit the breakout move in gold, you still could get gold to 2300, 2350 in that scenario, maybe even 2400. So that's also going to give the miners some juice. But looking at the breadth indicators, I'm looking at the percentage of GDX or Huey stocks that closed above the 200-day moving average. And I'm looking at that versus and some other indicators. And so there's 6 similar points in the last 7 years as to where we are now. 3 of those were strongly bullish, meaning there was additional gains in the short term. There was one that we'll call it mildly bullish, which was last year actually, which was triggered at the end of November. And then the 2 other ones were, you had one peak in 2021 and then one peak in 2022. So when looking at where the breadth indicators are right now, they're basically either telling you the market's in a downtrend and this is a sell signal. However, the other side of the equation is this is actually a buy signal, because there's enough momentum and sustainability to this move, and the larger move looks to be, the price action looks to be bullish, and therefore there's going to be additional gains. So I'm leaning towards, I'm leaning towards the bullish camp, mainly because there are 2 reasons for that. Again, gold really close to breaking above 2100, and then secondly, which we already went over, the price action now is much more bullish than it was compared to those 2021 and 2022 peaks.
So are there any individual stocks, especially on the miner front, that you are watching simply because, look, the miners, the big guys, have rebounded, arguably the strongest, and we all know that when bigger money comes into the sector, well, that goes into the bigger stocks. We haven't seen the same sort of rebound in the junior, but it can be much more encouraging for the big stocks to move and continue their move higher. Any individual stocks that you're driving down to as a barometer for a continuation of this move?
Honestly, not really. I just focus on, I think, GDX and GDXj, and then also the silver ETFs. I mean, those contain all the big stocks. And I think generalists and institutional money prefer to buy GDX and GDXj instead of individual stocks. I mean, in some cases, they'll go into some individual stocks. But I think on the whole, GDX, GDXj are a better indicator. I mean, I know some people like looking at Newmont and Barrick, but I prefer looking at the ETFs just because you can look at all these other breadth indicators and things like that. But I will say with the juniors, I do think, you have the tax loss selling being over, so that always helps them into January. And then you have the potential here for the larger sector to really move at the start of the year, for all the reasons we've already mentioned, and especially if gold breaks above 2100. So I do think some money will definitely filter down into the juniors in January. Now, as far as how long this can go, how sustainable it is, that will depend on the macro, which we talked about last week, how it's, really people spend too much time on that. But for here and now, I think there's potential for GDX to move up to 40 and GDXj to move up to 50. Like that's the potential move you could see in the next month or two if this comes to pass and gold breaks 2100 and these signals in the miners aren't going to fail us.
Well, Jordan, I think a lot of people listening would be pretty happy to see breakouts to those levels in the GDX and GDXj. Let's dive a little bit more into the market breadth comments you made, though. Maybe just share with people that are not technical analysts why you look at breadth, why it's important that the Huey, that a lot of those stocks, the majority of them, are over the 200-day moving average. Why do you look at those moving averages, and what kind of a signal is that really you could use it for any market, but just to help people understand why you're encouraged by what you're seeing.
Yeah, well, breadth indicators, they tend to lead price action in both directions. So that's why it's important you have to look and analyze the price action and then look at a breadth indicator secondly, because they can confirm what you're thinking or disprove that. When you're in a bull market or a bullish move, for example, typically breadth indicators will show a significant amount of strength early in that move or in the middle of that move. And if that goes along with bullish price action, kind of like what we're seeing right now, that's giving you more evidence that there's going to be a continuation of this move before you get to some kind of a peak. For example, 80% of the Huey stocks have closed above the 200-day moving average. And so I'm looking at the last couple months, that specific data, and I'm kind of looking at the percentage that have closed above the 20-day and the 50-day. I'm looking at all those, and I'm making marks on these charts. That I do the same for GDXj also, and I'm marking all these charts and look. Okay, what were the similar points? And so then we get a sense of, okay, what's possible, based on what has happened, and when these types of levels get triggered in these breadth indicators, what are the potential outcomes? And so it's really clear that we're at a point. The miners are still in a larger downtrend. This is going to be a sell signal. And I think the weight of the evidence favors the other scenario, which is, this is we're in a, I don't want to say a bull market yet because that's a whole nother conversation, but we're in a potential bullish move here for the medium term. So again, based on the breadth indicators and the price action as well, it's giving you more evidence that this move is likely to continue and that we're likely to see further upside. And then of course you factor in what are the metals prices doing? Oh, by the way, gold is really close to having this really significant breakout above 2,100. So when you're analyzing markets like this and you're looking at all these technical signals, you want them to kind of line up with respect to a potential conclusion. Like when they're all kind of lining up and telling you the same thing, that means you have very strong evidence. So this type of analysis gives you a better sense of, the potential, probabilities and outcomes versus if you're just, let me just pull up this chart. Oh, that's a head and shoulders, but this is bullish. This is going to do that. Okay, that's the end of my analysis. That's why you have to look at all these things. And by the way, they don't always give you look at a bunch of these different things, price action, patterns, breadth sentiment. They don't always give you a perfect indication of where the market might be going in the next month or two. It's just sometimes there's points like the present when they all tend to be lining up in favor of potential outcome.
Okay. Jordan, I think that sums it up pretty well. Look, just some more follow through as we move into next year. It has been a very encouraging and strong move higher, especially in the large stocks and also in the underlying metals, gold and silver, but gold especially close to all-time highs. Just need that momentum to continue, and then undoubtedly more stocks will join in. So really just turns into a focus early 2024, and again, that momentum, the upward trend continuing. Jordan, thank you very much for your time and your time throughout this year. I hope you have a very happy new year. We will chat with you throughout 2024. And everyone be sure to go check out Jordan's website, The Daily Gold. Jordan, happy new year, buddy. Have a good one.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Your weekly fix on finance and investing. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we are continuing to focus on different resource sectors. In this segment, we're going to focus a bit more on energy and some of the critical minerals. We are chatting right now with Matt Badiali, editor of the New Energy Letter, published under the Mangrove Investor website, which I will link to within the weekend show posting. Matt, I want to start off in the energy field, especially in the oil sector, because oil, after a very impressive run in 2022 and some major gains being made in the stocks, well, it struggled a lot for this year, and the stocks really struggled this year and in a way kind of underperformed. But also we need to understand that oil price pretty much flat throughout this year. There's a number of different aspects that we can talk about, especially how it seems like OPEC is losing market share. But Matt, what do you think here as we end the year? Crude had what seemed like some drivers, like geopolitical issues and OPEC cutting production, that could have driven price higher. But again, price seemed very much flat, volatile. But where do we end this year in terms of the major catalysts?
Yeah, it's interesting. I think if you look year to date, I think crude is actually down year to date, or at the very best, it's flat in a year where there were a lot of really important catalysts. You had war in Russia with the invasion of Ukraine. You had this a lot of unrest in the Middle East that exploded in the Hamas terrorist attacks in Israel, and then you had the Red Sea cut off to shipping due to piracy. This should have been a year, it felt like, where oil could have been over $100 to $125 a barrel. And what we saw was a run from July to October that took it from, in the 60s to over 90. And then it's fallen all the way back down again. These tensions were a buy the rumor, sell the news issue. And we've seen that in the past with oil and gas as well. In the first two Gulf Wars, the oil price ran up until the shooting started, and then it came way back down. It is one of those markets where the issues in the Middle East just aren't enough to derail supply. And I think a big part of that has to do with the amount of oil coming out of the West. I mean, U.S. exports in October were 4 million barrels, and that's, that 4 million barrels per day. And that's really, really high. I mean, the highest ever, I think, was right around there. It was right around 4 and change per day. So this is supply coming out of a country that was the biggest importer at one point, and that's all due to really the shale revolution in the States. And we can't overvalue that. I mean, to reverse the U.S. from a net importer to a net exporter of crude oil really threw a monkey wrench into the supply demand of crude oil around the world. And we're still seeing the impacts of that. And part of it is that this turmoil that we see in the Middle East and in Russia doesn't have the same impact to the oil prices it would have had 15 to 20 years ago.
Matt, just along the lines of how pricing has responded this year in 2023, being mostly, let's just say, flat for the year, isn't some of that just the nature of the beast in commodities, where last year, 2022, oil and even nat gas were the standout sectors? They were the sectors that were bucking the trend. They were doing good because of inflation, but we've seen inflation moderating all of this year, and I'm sure energy played into that. Isn't it just the case that a lot of times after a big run in a commodity, the following year, it may be from an outperformer to an underperformer? So isn't some of this just the market finding equilibrium on what is a good price for oil? And in that stasis, how are these energy companies set up if energy prices just stay in the 70s?
Yeah, I think that's an excellent point. I mean, one of the things that I always said about oil is it's cyclical. The prices are cyclical. They don't just go up and up and up because they're capped. When you start pushing the gasoline price to a point, people conserve, which reduces demand. And that's not just in the States, that's a universal. And so, as an investor in ExxonMobil, say, or Occidental Petroleum, you have to decide what valuation you're going to use. So what is a good price for their production? And I think people are settling in the 70s, the 60s and 70s, and they're ignoring the spikes. So, in 2022, it's interesting. We remember that in 2022 that the stocks did very well, but the crude oil price started the year at 75 and it ended the year at $75 a barrel. And it went all the way up to $120 a barrel in that year. And so companies like Exxon, BP, and some of the big refiners had a tremendous year. And they actually had a really good 2023 as well, where their profit margins were very high because as oil prices fell off, their refined prices, diesel, gasoline, jet fuel, didn't fall as fast because they could blame inflation for holding their prices higher. So they had a pretty good year. That's coming to an end now. And as you said, like for example, ExxonMobil, these guys have come down quite a bit. We're looking at they were $120 a share September. They've come all the way down to $100 a share now. They're still well above where they started 2022, which was at $55 a share, right? So there is some profit taking. But if you bought Exxon at the beginning of 2022, you're absolutely thrilled today, even though the share price has come down 20%.
Well, and that's what makes this so interesting too, right? Is that these companies, like some other resource companies, are making money at current prices, but if there isn't that upward momentum, we tend to see stocks drift and lag lower. One major takeaway from the oil sector this year was major M&A deals. You compare it to any other sector out there, the biggest deals happened in the oil patch. What does this mean for 2024, Matt?
I think that you're seeing efficiencies. I think that we're at a place where those big integrated oil companies have been able to recover certainly their war chest, their cash positions from the COVID lockdowns, and they're looking to consolidate among the companies that maybe don't have the same cash positions, that are still struggling, but have the big land positions in the premier basins. Like the Permian Basin is still probably one of the world's, if not the world's greatest oil production areas today. And you have that fantastic mix of shale and conventional oil fields there. And that's kind of what we're seeing the consolidation around. When you think about the shale boom, the price per acre probably started out around $1,000 per acre, and it got absurd. And what that did was it made these oil wells very, very expensive just to get the land put together and the drilling put together and the fracking put together. There was so much demand for all of those things that the oil wells got very, very expensive. We took on a lot of debt. We burnt a lot of capital. A lot of capital went to money heaven because there was this expectation from Wall Street that every single well was going to be profitable. And then it wasn't. The oil price came down, thanks in part to OPEC pressuring the oil price. Those wells had to be written off. So a lot of money went to money heaven. We had a complete reset on the costs. And now the costs are starting to come back up, but we're coming out of a period where we were at a cyclical low in rigs working, and the cost per acre had come way down, and there were a lot of bankruptcies among the service companies. And so if your cost per well goes down, your profit margins are going to come back up. So this is, I think, strategically really smart of the big oil companies who know that we're not weaning ourselves completely off oil in my lifetime or in your lifetime. And so, if you're looking forward, oil prices are probably going to be above $60 a barrel simply because of supply and demand issues. If you can get your costs way down through an acquisition like we're seeing, this is a good time to buy.
Well, Matt, when you look across the universe of energy stocks in the oil and gas sector, is there a particular area that has your interest? And it could be that you mentioned the Permian there as a basin. It could be other basins that have your attention. Do you like nat gas more than oil going into 2024? Do you like small growth-oriented companies with a good growth wedge? Do you like the larger dividend-paying stocks? What areas do you really like out of the oil and gas sector?
I think I like the service companies at this point the best. Nat gas is the sector that I want to love the most, but we call it the Widowmaker for a reason. People always seem to get ridiculously optimistic about natural gas at absolutely the wrong times. And so when that gas was like $9.50 a thousand, and it came all the way back down, there were people who were getting really absurdly excited at the beginning of 2023 when it was at $4. I think that there were some people that were able to pick off some profits, in that kind of middle of the year, April to October period. But, it's just come way, way back down. The problem I have with natural gas, and this is an aside, but this is why I would warn investors about looking at pure natural gas. Almost every oil well that we drill comes with a side of natural gas. And we're getting regulation now that make it much more difficult to just burn that gas off. For years and years, what you would do is, if you didn't have enough gas to make it economic to put in a pipeline, you just lit a flare, and you just, it was a pretty little fire that burnt all the time, that got rid of your waste natural gas, because you can't just vent it. When the U.S. is producing as much oil as we're producing today, we are also producing an absurd amount of natural gas. It's going to be very difficult for us without a really cold year. The reason that natural gas prices went to $9.50 a thousand in 2022 is because we stopped drilling oil wells. That's why. Now it's game on again. And so I think you're going to see gas prices kind of range bound. And so I wouldn't be investing there. I would be investing in like a Schlumberger right now. All these companies have come up quite a bit, but the big service companies are going to be in a good position now going forward as we kind of come into a new cycle of drilling. There's capital around again. People have made some money. We're seeing oil companies, like we said, there's plenty of money for mergers and acquisitions, and that means they're going to have to make those acquisitions pay, which means they're going to drill. And so you want the companies, Halliburton, Schlumberger, are turnkey, that can come into these basins. They can do everything. They can drill the wells, they can frack the wells, they can service the wells, and you can get a nice dividend. And these are the big ones. I like the big ones because one of the continuing hallmarks of oil service companies is that these companies have the ability to snatch defeat out of the jaws of victory sometimes, purely from a business point of view. So I like to stick with the big ones that are they're globally known. You can go pretty much anywhere, and if there's an oil field there, Schlumberger is probably there.
It's a good point. These companies are survivors, and now it's been a better market environment than it was about a decade ago when oil prices were in the dumps and there just wasn't that much money around. Let's move over to another energy sector, much smaller, but got a lot more money coming into it this last year. That's the uranium sector. There's much more optimism around it, rightfully so, because it does seem like there could be some more reactors starting up. But boy, oh boy, I feel like we've talked about that year over year from all the uranium bulls. But just look at how good Cameco did this year. Matt, what do you think about uranium in 2024?
It's a bull market. I like to think that it'll continue. I mean, your point is right on with Cameco. I mean, you look at 2022 and Cameco effectively traded sideways. It had a couple of moves where it wanted to get rolling. It never could break through that $30, $31 range until 2023. We saw kind of in March, it kicked into gear. And it ran from $24 to a high of almost $46 a share. I think that when you look at energy globally, right, you have to include uranium. And for many years, when people would talk about shifting away from hydrocarbons to new energy sources, they were like, renewables, it has to be renewables. And then, after 5 or 10 years of putting in wind farms and solar panels everywhere, we realized, maybe we can't just rely on renewables, and we have to diversify. And uranium is kind of the first on the list. Uranium, we talked about this, I think, in the past, you need baseload power. You need a power supply that is there all the time so that when you come home, you can turn on the front lights, or you can cook dinner, and the air conditioner will turn on if you want it to. Without a baseload energy supply like coal or uranium or nuclear power, then you're stuck with batteries. And one of the things about battery tech is that we're not to the point where you can have reliable grid scale batteries for everyone. I know that that's coming, and I know that that's being tested in some places, but it's not at my house. It may be at your house, I don't know, but it's not everywhere. And people don't like rolling brownouts. It screws with your computers. You can't cook dinner when you want to. You got to wait to dry the clothes. It's a pain in the butt. So that's where uranium is excellent. Nuclear power is excellent. But the other thing that's happened in the nuclear industry is that there have been tremendous advances in reactors. And I know, Shad, you know a lot about this. I mean, the tech hasn't sat still over the last 25 or 30 years. And that's really important, because as we de-risk the nuclear industry, you'll get more uptake. You'll get more countries that say, hey, we maybe we should. And we've already seen that in Europe. There are a lot of countries in Europe that were no nukes ever to now nukes are part of their carbon-free energy supply going forward.
Yeah, absolutely, Matt. It's interesting to see how many countries have reversed course, and where they were maybe against this, let's say 5 to 10 years ago, they're now, when you go to the COP28 conference, there's a lot of commitments coming in from a lot of the UN nations on, hey, we're going to be building these nuclear reactors, as well as countries you wouldn't even expect in Africa and in the Middle East. So there's a lot of build. But when you dive down into the companies, what a lot of investors are looking at, Matt, this year was a pretty wild year. Really, the first part of the year was noted by a big pullback in the sector. A lot of people were getting kind of negative by the spring and summer. But then after the summer, we've seen across the board, most of the uranium stocks surge in a big way. They were some of the best performing stocks in the resource sector this year. But again, like we noted with oil, sometimes stocks that do really well one year maybe don't have as great of a year the next year. You mentioned you thought this rally could continue into next year, but with uranium prices up in the 80s and even close to 90 at one point, do you think that can sustain itself next year? Is there still more upside for investors positioning in uranium stocks?
That's a great question. These things, commodities are cyclical, and so it wouldn't surprise me to see uranium pull back. But one of the things that has changed about uranium, is the supply system, right? So there's a dynamic that's changing right now. We used to have the significant amount of uranium that came from the spent nuclear weapons, or the old nuclear weapons. We were taking them out of service, primarily the Russian ones. You probably remember the name of that agreement, but they would take them out of service and turn them into reactor fuel. But there were a fixed number of your reactors in the world, and it was, it would take 20 years. It would take longer to build a nuclear reactor and permit it than it would to build a new base metal mine. Those two things have changed. Number one, Russia's not doing that anymore. So we don't have access to, I don't know what that was. It was like 30% of the uranium supply we used to have. And it doesn't take 20 years to build a reactor anymore, because the reactors are smaller and safer, and they can be constructed faster. So you have the ability to bring on demand faster than we had looking back even in 2005, 2010. And we've cut a significant amount of supply. I think that we could see, especially if we continue to see the agreements where typically when you're going to build a new reactor, this is the way it was in the past, you had to have signed agreements for fuel supplies that were multi-year, 5 or 10 year long agreements. And so if you're signing up reactors to a decade long supply agreement, then you're mopping up supply really quickly in a situation where supply is being reduced because of that arms agreement ending.
All right, Matt, before we get you out of here, let's now move over to the critical minerals sector. one that is still garnering a lot of attention, but we've seen, at least this year, 2023, a pretty major pullback in a lot of critical minerals prices, and the stocks not garnering the same sort of money flowing into them. What do you think about critical minerals heading into next year?
Well, I'll give you one bearish case and one bullish case. And we'll start with my bearish case. I am tremendously bearish on lithium. And I know that you guys don't want to hear that, but and this goes back to the conversation that we had in previous pod, but the emergence of ExxonMobil as a potential lithium producer, taking oil field brines and using a direct conversion, just pulling the brine out, pulling the lithium out of the brine and putting the brine back in the ground, has the potential to really, really change lithium supply economics. So even though the demand numbers look good, I think lithium price could come down. And so you really have to be wary as an investor in these emerging lithium development companies of what's a lower lithium price do to your project. That could be a real punch in the eye for some of these new projects. And for producers, if the lithium price comes down further, they're going to get hit on their earnings. And so, you certainly will see investors divest and wait for a better price. So I'm concerned about the whole lithium market. The other side of the coin is I'm still very bullish on copper. The copper supply demand numbers they just keep pointing toward higher copper prices. Every day there's more news, unrest in Peru, where a third of the world's copper comes from. You have mine closures, you have a mine seizure in Panama with Cobre Panama mine, which produces, I think, 1.5%, or could have produced 1.5% of the world's copper, seized by the government and taken offline. So you have supply disruption and you have nothing but positive demand numbers. And so, I see copper as my commodity for 2024, with the caveat that I'm also looking at graphite, because I do think that the battery numbers just keep going up, and primary graphite supply it's one of those black boxes in batteries that I personally don't understand it all that well, and I haven't met too many people that can explain it to me, which means that there's potentially some opportunities there.
All right, Matt, thank you very much for all the time you spent with us throughout this year. It's been fun talking about the critical minerals space and diving into some of these other sectors. We'll chat with you throughout next year. And again, if you want to keep up to date on Matt's work, go to the Mangrove Investor website. Matt, Happy New Year. We'll chat in 2024.
Happy New Year.
To find out more about today's guests, visit us on the web at www.kereport.com. You're listening to the Corlin Economics Report. We'll be back in a moment.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And in these last two segments, we are shifting our focus a little more back to the resource sectors. We are chatting again with Joe Mazumdar, editor of Exploration Insights. Now, Joe joined us just a few weeks ago to talk about what he was doing with his portfolio. We talked a little bit about M&A in the sector. And we did also get some initial comments from Joe on leverage from the gold stocks to the underlying gold price, or I guess I should say the lack of leverage that investors have seen even just this year. We look at this year, gold's up around 12% year to date, GDX up around 10%. And I know a lot of us holding some of the juniors, those haven't performed overly well, but they have rebounded at the end of the year. Now, Joe, you've done some more research on leverage, especially when it comes to the producing stocks here, and why maybe they are not providing that sort of leverage that investors expect when we have seen a good gold price and even a rising gold price. Joe, what are a few things that stood out to you as to maybe why the gold stocks are being held back a little bit in terms of leverage?
Okay, yeah, thanks. After our discussion, I dug into this a little bit in more detail and, did a little rant in the weekly letter. And some of that was based on social media. Like usually social media is not a great place to spend a lot of your time, but there's sometimes good discussions that come out of it. And a friend of mine, Ron Stewart, from Gold and Copper Consulting, he produces these decent graphs about, and I encourage anyone to follow him, about 5-year quarterly operating margins based on the gold price and the all-in sustaining costs that are reported by, a number of producers, intermediate, junior, and major producers. And also another discussion in parallel by a European natural resource investor, Oliver Groh, I think it is. And he was just looking at Newmont. And so I sort of combined the two whilst looking at your point that, hey, gold price has not done so badly. Why have gold stocks that are producing, not provide the leverage they tend to do? One of them, we've talked about this before, might be that, most of the gold price rise was due to central banks, and we didn't see a lot of institutional equity or that wanting gold exposure. And I think now we're on the cusp of that obviously changing if we have peaked at real rates. And so going into 2024, there's a real, possibility that people will be looking at gold stocks again as an investment thesis for gaining more leverage to the gold price. And then the whole question became about leverage. And then in Ron Stewart's graphic, from the first quarter of 2019 to the third quarter of 2023, you could show that the leverage, all-in sustaining cost leverage, as gold price went from about $1,250 to new peaks over 2,000, and the gold price went up 60% over that time, the all-in sustaining costs went up about 40 to 45%, from about, $850 to $900 an ounce to, about $1,250 per ounce. So that made the margin basically contract from a peak of 48% in, latter part of 2020. And it actually went down to 30% the end of 22. And it's been coming up, but still it's only 36%, even though gold prices jumped. And so that was like, well, what's going on here? And so what I noticed this before when we had Pan American Silver in the portfolio, and I took it out because I saw their margin compression back in 2022, and we sold back in 2021, I believe. But I saw that compression happening, and so I stayed out of producers. And so when I started digging into, let's say, just use Newmont, the biggest producer, this is pre-Newcrest, they're all in sustaining costs. And so from 2021 and previous to the end of 2022, Newmont was using a gold price for the reserves of about $1,200. And then it was just in 2023 that they increased it by $200 an ounce to $1,400. And what you could say is that they were thinking at the time when they produced a sensitivity when the gold price was $1,200 in the reserves, they said that, okay, if we increase our gold price to our reserves using a gold price of $1,400, we add a significant amount of reserves. So we're going to add about 13% more reserves. We're going to go from 92.8 million ounces to about 105 million ounces, they said. But then when we look at the actual results from that year, that $200 change in gold price got them from 92.8 million ounces to 96.1 million ounces. So, a much more modest increase of 4%. And if you dig into the details even more, the 3.1 million ounces of that increase was basically increasing their ownership of Yanacocha. So if you take that out, you're basically flat, 92.8 million ounces going to 93.1. But what happened to their all-in sustaining costs was, increasing the gold price by $200 an ounce brought in a lot of low-grade material. And the biggest change you can see is in their ownership of 38.5% of Nevada gold mines. So you could see a tonnage increase of 12 to 13% and a drop in the grade of about 15%. And so, that negatively impact their entire all-in sustaining costs because it's such a big part of their reserves. It's about 20% of the reserve profile. And so that's something to look at when people are looking for leverage in 2024 is anybody changing their cutoff grade? So if we do see a change in cutoff grade, we're all happy. Okay, that means that there's more ounces, but we got to know that, those ounces are going to come at a higher cost. And so, is the leverage actually going to get diluted? On a positive note, the input costs, might be flattening if inflation is flattening, but mining is still exposed to, labor rates, diesel costs, obviously, and power. So those things we got to keep watching for. And then if the company you're looking for leverage from is in a capital cycle and building a project, then a lot of that free cash flow or operating cash flow, will be going into maybe development and investing cash flow. So even though we're bullish about, a change in the gold price, we might not get a 20% increase in gold price because it's not done that badly this year, but we want to get back to a 1.5 plus beta to the gold price, which we're not at right now. So hopefully we'll see that going forward. But I just want to make people aware of is if the gold price increase, allows people to, change their reserve prices, we'll see lower cutoff grades and we'll see more higher all-in sustaining cost ounces come in.
Yeah, Joe, I think that's such an interesting point to make because we're going to see kind of those games finagling the higher gold price with the lower cutoff, bringing in reserves that are maybe not as marginal as some of the best ounces that were already in production. And so we may not get that big margin expansion we're hoping for in some of the largest companies when you look at the massive reserves they're trying to juggle. But a lot of people would point to some of the small to mid-sized producers that maybe don't have as much change in reserves, but maybe just a margin expansion from a rising gold price and moderating to lowering input costs. A lot of people look for those kind of subpar producers, Joe, where they think, hey, if we see a $100 or $200 increase in the price of gold or a $1 or $2 or $3 price of silver increase, then these margins can increase on a bigger percentage rate than the biggest producers. What's your thoughts on playing that angle, the beta from the smaller to medium-sized producers?
No, I think that, we might be on the cusp of actually these companies offering leverage, but especially if they're not, changing their cutoff grades, because I do think some of these input costs might be flat year on year into 2024. And, we're all bullish about, that the gold price will still stay positive. So I'm just sort of saying that if a company you're looking at for leverage, dig in a little bit into the details in terms of, what their plans are for 2024. And if there is any discussion about maybe dropping their cutoff grades in certain mines, adding ounces, and that may be great on an ounce basis and a revenue basis, but just know that, some of those ounces that'll be coming in, if the reason is that the cutoff grade has been lowered, won't be coming in with the same margin as those last ounces.
What about the current ounces that are being produced? What about some of these small guys that maybe aren't looking at increasing production, but they've been grinding along here, kind of churning through money? But if the gold price goes up a couple $100 more, the silver price goes up a couple dollars more, then they'd actually be in the positive. Would that change your assessment or the market's assessment of these stocks?
Oh, absolutely. I mean, if you look at something like back in the day, we had Claude Resources, a marginal producer in Saskatchewan with a growth project that they couldn't afford to build, and they had debt on their balance sheet. And as they removed the debt and got that project up and running, they got taken over, but they provided, investors with 4 or 5 times return in a small period of time because of the leverage they had. The leverage cuts both ways, but the thing is that if you're very bullish on the gold price and you're comfortable that the company's production profile is what it is and they're not looking at changing their cutoff grade and their margins right now are basically marginal, there's a good chance that they could increase exponentially if the gold price goes up and everything else stays just about the same, or even maybe better with respect to the costs input.
Well, Joe, another wrinkle that we can throw on here is how did the share count get diluted over this time period? Because there are some companies that have continued to dilute for different reasons. Sometimes it was to make an acquisition. Sometimes it was to build a mine. Other times it was just a feature of the market and being in a bearish market. But a lot of people point to, even if margins are roughly the same as they were in other periods of time where the miners perform better, the dilution effect over time has also eaten into it. How do you balance the dilution out with maybe some of the growth profile that they did with that dilution by buying other companies, building projects?
Absolutely. I mean, so we are investors in the stock market. So we don't own debt. We don't own a stream. We do not own a royalty. We're taking everything on a per share metric. And so if a company over the past year or two had to continually raise capital in the markets to, just keep the lights on with respect to their production or sustaining capital, then we'll see that sort of leverage decay. I mean, the leverage I'm talking about is mostly on a margin basis, but not on a per share basis. Does the increase in the margin suddenly mean these guys are going to come back to the market and make a big private placement because now the markets are buoyant? I would absolutely expect that to happen in 2024, before the next fuel season, that if the market is more buoyant, then there'll be a lot of people heading to the capital markets. So that's something else to think about when you're looking for leverage on a per share basis, let's say.
So, Joe, to me, this is all sounding so asset specific here, especially when you look at what Newmont did, changing their reserve price and not bringing in that many more ounces brings up the question that, are we simply running out of tier one assets that make so much money that they can be company makers, where we're dealing with kind of lower grade assets, and maybe they're just the higher grade assets are in tougher jurisdictions, but is the problem right now that maybe all the easy assets have been found or at least are already well known?
Well, yeah, I mean, the thing is, you have these spectacular discoveries like, your snow lines in the Yukon, decent grade deposits that are being, discovered or developed in Guyana, Reunion Gold, that sort of stuff. But I mean, they're few and far between of these projects in good jurisdictions with decent margins and upfront capital costs that are not in the multi-billion dollars, let's just say. Because some people will just go for jurisdiction. So they'll take, the knock in grade, they'll take the higher costs just to know that, they don't get expropriated or the tax stability agreement doesn't change. Or, the infrastructure is so horrible that, they pay a lot, for other things. It is getting more difficult, and the other problem is that a lot of the money spent in exploration, hasn't really found much. And, because the market is short term, people like to drill those holes that they know they're going to get a good result in. And so we're not really doing a lot of grassroots stuff. And grassroots stuff is really what, can be a game changing, find these game changing assets that you're referring to, as opposed to drilling the same old hole. And I'll put a little bit of a caveat on the idea of jurisdictions or places like, the Walker Lane belt of Nevada, that, that place was looked at, trodden upon, but every place has these little wrinkles. And that wrinkle there was that there was a lot of land there that was basically not allowed to be staked because of the potential for the need for that land for the nuclear repository at Yucca Mountain. And when Yucca Mountain was taken off as a solution for depositing nuclear waste, that ground came free. Renaissance Gold, now Origin Royalties, staked that area, did a joint venture, an earning with Silicon, on the Silicon project with Anglo Gold. They've discovered, in an area that has been trodden, basically a blind low sulfidation epithermal deposit that, they're comfortable has over 10 million ounces in it. So, that is definitely a tier one asset that has been discovered, being delineated, and potentially, hopefully developed in the next few years in Nevada. So, it's not like we can't find these deposits. It's just that, we need the more longer term money going into these grassroots plays. And the problem is that the majors don't always do a lot of grassroots exploration. The juniors who we expect to do the grassroots are at the vagrancies of the capital markets. And so, if they don't get that funding for that next drill program, they're basically not going to be drilling a big program. And so it's harder to make those discoveries.
Well, Joe, when you bring up the silicon deposit that Anglo Gold Ashanti has now, it does make me think of what they did there in the Walker Lane trend, where they bought Corvus for that little Linma strip that had some of the same kind of mineralization. And they also bought the Sterling deposit that Coeur Mining had, originally explored by Northern Empire before Coeur took them over. And they kind of consolidated that whole district. Do you think we'll see some of the larger companies start doing things like that, where they buy up their neighbors, where it becomes a true large regional stake here of all the properties, and where we see more M&A of closeology plays?
Yes, I think that if you find something and you're a major company with a lot of capital to deploy, deep pockets, let's say, the first thing you'd want to do is consolidate that district. You don't want little eyes where people own parts, because you never know where you want to put the processing facility. You don't know where you want to put the tailings dam. You don't know if there's more mineralization under that. So you always want everything around, and consolidation is the way to go. And so, and also water rights. You don't know where the best water spots are. There might be a place with a closed basin on somebody else's ground that you might buy them only for that. You might not even buy them for the resources. You just know you've got over 10 million ounces on your stuff. You just want to make sure that all this other stuff, and you might even be happier if it's dead. That way, you know that that's where all the facilities can go. So yeah, absolutely. When a major gets a hold of something, they definitely want everything around it.
So, Joe, bringing this full circle, this whole topic was brought up really because we talked about how investors or sentiment was still low for gold stocks, even though, let's say, gold was at all-time highs or very close to all-time highs. And a lot of people have correlated it to these rising costs. So as we move forward here, and again, the gold price is still doing well, and costs, maybe they've stabilized a little bit. But again, looking back at what Newmont did, that is maybe a little cause for concern, where they just didn't bring in that many more ounces. Where do you see sentiment taking us if, let's just say, we are in an environment here where margins don't explode higher, but they do remain healthy?
Yeah, I mean, the thing is that right now the valuation suggests that, and that's all driven by negative sentiment. Just a change in sentiment will have a positive impact on these valuations. Just knowing what we know right now, without a big change in gold price, it's just that the sentiment towards gold is much, much better. Now we got to say, well, now what do you do with that? How do you add more value, by controlling your costs, showing growth, finding new discoveries by doing more exploration. That's really on the individual company. So that's how people will, even though we might have a beta environment where all boats go up, we can always go back to the alpha environment. And so those are some companies that you might want to look at that do operate and think about controlling costs, think about growth, and think about exploration as well. Those are definitely some companies you'd want in your portfolio.
All right, Joe, thank you very much for taking some time with us on this New Year's Eve edition of the KE Report Weekend Show. New Year's is coming at the end of this weekend. We hope you all have a great weekend, a great long weekend again. And, well, I think we're all looking forward to 2024 and some improvements, continued improvements in the markets, because we are definitely ending on a strong note. And then, well, it just needs that carryover. Joe, thank you very much again for your time. I hope you have a very happy new year. We'll be seeing you in Vancouver at the upcoming conferences and also having you back on later in the month.
Great. Thank you very much, guys, and Happy New Year.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.